All right. Hello and welcome to our Educators Homebuyers Seminar. We are so glad you're here. I am Lacey Rushing with the Rushing Realty Group. And we are offering you this presentation today with our agents on the Rushing Realty Group team, as well as our preferred business partners. We know, like, and trust them. So we are going to go ahead and talk to you today about all kinds of things, from credit strategies to mortgages, home warranty, home inspection. This is kind of an overview of the process, right? From getting approved, or maybe even before getting approved, if your credit needs a little bit of work like mine did, all the way through making an offer, money out of pocket, to closing, to after closing. So with that being said, I'll go ahead and hand it over to Carrie and we'll get started.
Good morning, everybody. Welcome this morning. We're glad to have you guys on us bright and early on a Saturday morning. The first thing we're gonna talk about is the benefits of shopping with a realtor. The main thing that we can do is we can scout out new listings for you on and off MLS. We have access to homes that are not listed on MLS, and we can work with those. We can find those for you. We can also accompany you on tours. Believe it or not, people don't let you in their house without a realtor, so we have the magic key that lets us in. We also provide you with inside market knowledge on any properties that you're interested in. We negotiate on your behalf with the seller. We offer advice about a home warranty, and we'll talk more about home warranties in a little bit. We have vendor recommendations, movers, repairers, lenders, contractors, landscape people, pool people. If there's a vendor out there to be had, we have probably worked with them at one point. We have access to new home builders if you're interested in a brand new home. We provide information on schools, taxes, and utilities. We can negotiate potential repairs to be paid for by the seller after your contract is executed. We can answer questions along the way, and we accompany you when you go to closing. Well, we used to accompany you when you go to closing. At this point right now, where we can't exactly go, but we wave at you from the car. So the first thing you need to do, and when you're getting ready to buy a home, is you need to get pre-approved with a dependable lender. And we're going to talk to James, or James is going to talk here in a few minutes, and he's our dependable lender that we love and trust, like Lacey said. The next thing you're going to do is you're going to meet with your realtor to discuss your wants and needs. You're going to tour homes, you're going to go to open houses, and you're going to find the perfect home, the one that gives you warm fuzzies when you walk in. Your agent's going to do a market analysis. We're going to pull the tax record, the survey, the seller's disclosures, any information that we can find on that house, so that we can give you the most information we can about that. We're going to make your offer for you. We're going to receive counter offers, and we're going to accept acceptance of the offer. In that, we also negotiate for you with the seller. All parties sign an initial final changes, and the contract will be dated, and at that point the clock starts, and we'll explain the clock part in a few minutes. Home inspection and option period will be listed on the contract. We're going to negotiate any repairs for you. We're going to finalize your loan, including appraisal and funding, and then we're going to go to closing. So the first person that we're going to hear from is James. He is a residential loan originator. So we're going to let him take it away, James.
Thanks, Carrie. Yeah, my name is James Hoagland. I'm with American Mortgage Company. I've been in residential lending now coming up on 20 years here in a couple months. I've done it from the small side, broker side, to the big bank side, to the mid size, and now I'm back to the broker. And what's that mean for you? Basically, and before I get into the slides, when you go to Bank of America, you've got Bank of America. When you go to Wells Fargo, you got Wells Fargo. When you work with a mortgage broker, I've got the ability to shop around and find the right program for you. And we'll talk about that in just a second. So just to kind of clear it up, I'm a mortgage broker, so I work with a lot of investors. Why should you stop renting? Right now you're paying somebody's mortgage already. It's just not yours. So if you've got the ability to buy and it makes and the numbers and it makes sense for you, why not buy? Because like I said, you're already paying a mortgage for you or for somebody else. A lot of times what you're paying in your rent payment could be very comparable to your mortgage payment. And then it also allows you to own home, build equity. It increases your tax write-offs it's tax deductible. And then you're the landlord when you're buying your own house. You want a pink room? I say this every week. You want a pink room? You can have a pink room. And in my first house, I had a pink room because my wife wanted a pink room. And believe it or not, now pink is my favorite color. And I would probably paint a room pink if my girls wanted it to. So there's a lot of benefits to it. Actually, too, if you look at a Forbes article, when it talks about building equity or net worth, it all starts with home ownership. And so, when you say, okay, well, can I qualify? What do I qualify for? There's a lot of things that go into that. The main things we look at are your income, your current debts, your credit history, and your cash available. And when I say current debts, I don't mean how much you owe. We mean how much you're paying on a monthly basis. So if you've got a $3,000 Amex or Citi card bill and you're paying $200 a month, we look at what your minimum payment is. You're only required to pay $23.82 on it or whatever. That's what we look at. We put all that together and come up with a calculation on what you qualify for. That's the loan amount. Then we can also look at it from how much do you want to pay? Well, James, my rent is $1,800 a month. I'd like a house payment that's going to be comparable to that. Well, that's not $400,000. That might be $225,000. And we kind of work both ways there. So that's how much we figure out how much you qualify for. A lot of especially with educators, a lot of the, one of the two main questions is, do I need 20% down to qualify? And what if I've got nothing to qualify or no money? Great grammar when I'm talking to educators. There are programs out there to help you get some assistance with down payment assistance. Maybe that works for you, maybe that doesn't. And when we work together, that's what we'll talk about. But the biggest misconception when it comes to buying a home is that I need to have 20% to purchase a home, a 20% down payment. That's absolutely not true. Depending on your area where you're looking, there's a USDA program, which has a 0 down payment. If you are a veteran or you're married to a veteran, there's the VA benefits, which is 100% financing. And then also you've got a 3% Fannie Mae first-time homebuyer program. And then there's also an FHA at 3.5%. So just to put that in perspective, if you're looking for a $200,000 house at 3.5%, that's usually the most common that we look at for FHA. It's $7,000 plus closing costs. And we'll talk about additional closing costs right here, right on cue, Carrie. So people think, hey, I need a 3.5% down payment. I'm buying a $200,000 house. I've got my $7,000. I'm ready to go. Well, you've got your down payment and your closing costs. And your closing costs are made up through fees and services that go out throughout the process of the loan. You've got some lender fees. We keep ours to a minimum. And then you've got third-party fees, your taxes, attorneys that draw it up, the title company. Those are all services that are required when you're using a mortgage. You got title insurance and all that. We don't have it. Do we have a title person on today? I don't think we do. So I don't want to get off too much into theirs, but it's just fees that are services that go on with the transaction. Also, you've got to set up money for your taxes and your insurance, your homeowner's insurance. So usually, it's people say it's a percentage of your sales price. It's not necessarily true. Your taxes can really eat up, but on a $200,000, you need $3,000 to $5,000. At $300,000, you probably need $4,000 to $6,000, right around there. But there are also ways, and I don't want to get into their realm either, but there's ways of having the seller pay for that. And that's when you're working with a great real estate agent like these ladies here. I've seen them negotiate some really, really wonderful scenarios where the closing costs were covered. It's not done like that every time, but when you're working with a professional real estate agent, that's what, one of the benefits that they can do for you instead of you going out on your own. One of the big questions I get too is, how does my credit factor into the loan? And I'll let David get into a lot of this too, because David's going to talk to you guys about credit repair, but your credit is absolutely paramount when it comes to this. Don't let that be a daunting phrase, but your credit absolutely matters. It affects your interest rate, your down payment, and your loan amount. And so not to steal David's thunder, and this may sound better coming from somebody who's not, talking about their own program, But if we get into a situation where we need to talk to a credit repair person, the number one thing you need to do is talk to a reputable credit repair person. And David, that's coming up, he's one of our favorites. He's honest, he's hardworking. They do what they're going to say. And a lot of people say, well, what about the cost, James? It's going to cost me a lot of money. I'm not going to get into the cost of what it is because they're different case by case. But the money you invest into a credit repair process that works will save you 10, 20, 30 times that investment later on, because it's going to affect your interest rate. It's going to affect your down payment. It's going to affect your loan amount. It plays into everything. So credit is absolutely paramount. We talk about being pre-qualified or pre-approved. You hear that a lot out there. Pre-qualified, I can talk to you for 5 minutes over the phone. How much do you make? What do you owe? Where do you want your payment? That's what you're pre-qualified for. When you're pre-approved, I've taken your income, your asset statements. I've pulled your credit. We've run it through underwriting. I based it off of the payment that you wanted to be. You are pre-approved. We have underwritten that file to where we already know what our limits are going to be. And now we've got a letter to hand to the real estate agent who hands to the seller that says, hey, these guys mean serious. They've already spoken with the lender. They've been pre-approved, and real estate agents know what the difference is big time. So if it doesn't really register with you, that's fine. Your real estate agents do, and you want to be pre-approved. That means you've done your due diligence and you've done your work before, and now you've got a serious offer in hand. So I don't do pre-qualifications. I do pre-approvals, and you don't ever want a pre-qualification. So that's kind of it in a nutshell. We can talk for hours on that, but I'm going to let it go over to David Rodriguez. My contact is there, and then you guys will get this. If y'all have any questions, even if you're not working with me, but you're working with somebody else, but I said something that, give me a call. I'm happy to help. So thank you guys for coming this morning.
Thanks, James. I appreciate your information.
Absolutely.
Now we're going to move on to David, and he is going to tell us the ins and outs, an overview of the ins and outs of credit. So I'm going to let David take it from here.
Thanks, Carrie. My name is David Rodriguez. I'm with the Phoenix Group, and basically what I do is I help create homeowners. Can you guys hear me good? Okay. So a lot of people ask, well, what exactly is credit? Credit is a formula, a numerical rating, if you will, that ranges from about 300 to 850. That is basically a history of your habits. It is a risk factor that is given to you based on your past credit accounts. Very, very important. There are three major credit bureaus, and these are Experian, Equifax, and TransUnion. And a lot of people are under the assumption that these are government entities. They are not. They are private, out-for-profit companies. They own your credit. And some people will notice that the three bureaus will have different information reporting to those. And that is because a creditor actually has to pay these three bureaus to report your information. So these guys are not on your side, but they do report all of your information. When it comes to credit, there's several different types of accounts. The two main accounts that are on pretty much everyone's credit report are installment loans and revolving credit. So revolving credit is your credit cards. These are open-ended accounts that you have to manage. Your payment will change based on the usage, and you can have these accounts forever. These are very, very important when it comes to buying a home and even establishing credit, because it is an account that is going to have longevity of payment history. Installments, your mortgage, your auto loan, personal loans, your student loans. These are installments because you have a set payment. You have a high balance, and every month you make that payment, the balance will reduce. A lot of things that don't report are your utilities, your cable, your cell phone, your insurance, your rent, and a lot of times payday loans. Again, going back to the credit bureaus being paid to report this information, a lot of those utilities will not pay to report it unless you default, because now they have a reason to. When it comes to establishing credit, as I mentioned, your credit cards are going to be the biggest factor. Paying your bills on time is going to be the biggest thing that helps get somebody financially stable or financially worthy, credit worthy, if you will. And on-time payments, I cannot stress it enough. Also keeping your ratios low. We all hear that 30% or less on your credit cards is a good place to be. You do get a benefit from that, but if you can keep them lower, then keep them lower. One thing we don't want to do is have it all the way to zero unless you're just well established. Paying them down to zero will sometimes show zero utilization, and you're not going to get a benefit. Now, preparing your credit for buying a home, you want to make sure that you're ready by talking to a lender. He'll let you know, get you that pre-approval. And if there is any issues on there, he's going to explain what those are. Now, most people that are ready to go, they do have 2 or 3 lines of positive payment history. A lot of times these are credit cards and your auto loan. You want to have your debt below that 30% mark, because as James said, when they look at your minimum monthly payment, all these bills that you have to pay on a monthly basis are going to be included in your DTI, and you got to keep that under a certain limit. So having low balances is very important. Another thing that we all hear is don't open up anything. Nothing new while you're trying to buy a house. We don't want to apply for anything. We don't need inquiries on our credit while we're trying to buy a home. You don't want to close any of your loans, because if you were to pay off your car, make a huge payment and just pay off your car, you may actually drop your credit score due to the fact that you no longer have the payment history on that account. So when you close something, your credit score will drop a little bit. Now, we can always talk about the extenuating circumstances to bounce back from that, but you want to put your credit on hold. Don't do anything with it unless you're instructed by, your lender or possibly someone like me that works with credit. And of course, don't make any new major purchases, because when you open a new loan, you are taking on more risk. So just put it all on pause.
Thank you so much, David. That is fantastic information. And if, like James said, all of their information is on the slides, and you will receive this presentation. So if you have any questions about credit or any questions at all, reach out to the person that's talked, so that they can, we've vetted these people out, so we know they know what they're doing, and they can always answer any of your questions. Now we're going to have Michelle tell us what you need to do to choose your perfect home.
Good morning, everybody. Thank you so much for joining us this morning. I wanted to touch base on a few of the key points that I discuss a lot with buyers when we first start to look. And first, I want to touch on make a dream list. I mean, this is real critical for a lot of people. Like, what are you really looking for? You're looking for a 4-bedroom, 3-bedroom, pool, no pool? Do you want a large backyard? Do you want a big back patio, an open concept on the inside? Do you care about those things? Those are things that really help us narrow down when you're looking for a house, and we can help you with that. Including the features that you want in the neighborhood. Do you want to park in the neighborhood? Do you want a neighborhood pool? Are you looking on a golf course? Those things are real important for us when we're kind of narrowing down your home. So also think about the schools in the neighborhood. That is so, so important for a lot of people when they're looking for homes. And there's a couple good websites out there. One of them is called greatschools.org. And that's one that I go to quite a bit that can kind of help rate the schools. So if you're looking for a 5-year-old that's getting ready to go into 1st grade and you kind of want to know what where they rate, that's a good option for you guys. Visit the local stores, churches, schools, etc., just so you can kind of get a feel for the neighborhood and what you're about to embark in when you actually live in this home for the next 5 to 10 years. Drive around the neighborhood at night and on the weekends. I highly, highly recommend this for everybody, just because when you might go at, say, 12 o'clock on a Saturday, it might be a totally different environment at 5 o'clock in the middle of the week. You may see a lot more people walking around that may give you a better vibe of the neighborhood. Ask the neighbors about possible things that you might not have noticed. And this is real critical, I feel like, because a lot of times when you have run across a neighbor, they'll tell you about neighborhood events or things that they do in the neighborhood. I have a seller right now that is selling her house, and she's super sad because the neighborhood she is in, she absolutely loves. So she hates to leave that community sense that she's built there. Ask the neighbors about possible things that you might not have noticed. And this is good too as well. I mean, are there people in the neighborhood or things in the neighborhood that may not fit your lifestyle or what you are looking for in a home? Do you not want the HOA and the strict restrictions that they have, whether it comes to fences or paint colors and things like that? Some people just don't want a HOA. Look at the aerial views, such as Google Maps, train tracks and sewage facilities, electrical wires, things like that. Some people really care about electrical wires. Other people just, it doesn't matter to them. So that's super important as well. When recently I looked at aerial view and there was a hoarder that lived next door and the whole backyard was covered and stuff. So it's just stuff that you might want to see before you actually go and view the house. Pull up the crime rates and statistics of the neighborhood. There's 2 websites I go to, SafeWise and neighborhoodscout.com. Both of those are good as well. That may help give you a little insight on what's going on in that area. And then of course, ask your realtor for a market analysis or comps of the neighborhood. And that's the first thing that we really do when we are looking at comps. We pull that up and share that with them when they're interested in putting in an offer. So if they are interested in going ahead with one property and going forward, I run comps and tell them where that house is actually priced at this point and how negotiable they'll be. Earnest money. Earnest money is generally 1% in Texas, so we pretty much stick to that. It's not a steadfast rule, but if a house is $300,000, we usually put around $3,000 down as earnest money, and that's just your skin in the game to prove to that seller how committed you are to purchasing that property. And your option money. Option money is usually around $100 to $300. I usually do around $150, depends on the price of the house. And this is money due in the first 72 hours once you go under contract. So once everybody has signed the contract, in that first 72 hours, that money has to be delivered to the seller in order for you to now do an inspection on that property and see if this is a house that you want to move forward on. The third-party inspection, I just talked about that. Usually that price is between $375 to $475. And that gives you the opportunity to really see beyond just visually what is going on, whether it's the foundation, whether it's electrical issues, whether it's the HVAC. These are all things that can make a difference if you want to move forward on that property or not. Appraisal. Appraisal is another fee that comes into play that the lender will ask you for once under contract. We usually try to wait until after option period to get that money, just so that we know that we are moving forward on that property. And that's the lender such as James would ask you to do that, to pay that in order for you to see that that house does appraise at the value that we have offered it at. Down payment, like James talked about earlier, down payment can be 3% and it can be no percent. It just, there's a lot of different variations that we can do as far as down payment. But again, that's something that the lender will get more into detail with you on that. Closing costs. James also touched on this as well a little bit. And again, closing costs can be paid by the seller. I have a contract right now where the seller's paying $5,000 towards closing costs. So if you have anywhere between $5,000 to $7,000 in closing costs, the seller's already pitching in a good majority of that for you. So that's a negotiable thing. So once we go into contract, that's something that can really help you in the long run. So any questions, please reach out to me. My name is Michelle Swann, and I'm very happy to have you guys all here.
Thanks, Michelle. Now we're going to hear from Sarah, who's going to explain what happens when you actually find that house and you decide to make an offer.
Well, congratulations. We are now at the point where you have found that house that gives you the warm and fuzzies. Congratulations. And you found the house, and you'll determine what offer you're going to make. And your agent, who has given you market value for your home based on comps in the area, you are going to make an offer with your agent negotiating on your behalf. And what this slide talks about, if there is competition for the house, if there's more than one buyer looking for the house, then you may pay more for that house because there's competition. It's the basic supply and demand. If there's less competition, then you can make a different kind of an offer. But if you really want this house, then you may have to come in with a really strong offer, which often means at list price or a little bit above. But you do have to be careful because there's the appraisal to consider down the road too. So congratulations, you're making your offer because you have found this house. And once the seller accepts your offer, Maybe you've made an offer, maybe there's been some counter offers. At this point, hopefully you've come to an agreement and your contract has been executed. Okay. Michelle, who I work with, she mentioned the option money and the earnest money. The option money is for the option period, which is typically 7 to 10 days once you've executed the contract. And that is when you hire and pay for an inspector who will do a general overview of the condition of your house, and he will point out any kind of flaw. And we'll talk about inspections later, okay? During that option, that is the one time that you can safely back out of your contract and get your earnest money back. And Michelle talked about earnest money, which is that good faith deposit there. So we talked about the option money. If you do back out during the option period, you will lose your option check, which is maybe $150. And we pay that to the seller because they have accepted your offer. They cannot accept any offers, and they've taken their house off the market while you're having your inspection period, your option period.
All right, thank you, Sarah. Thanks for that information. And this is a slide that we like to use. It gives you an overview. Most closings take 30 to 45 days, and there's a lot of activity that happens in the beginning. You're looking at houses, you're negotiating your contract, you're figuring out your inspection, what day you're going to do your inspection. You have a meeting with the inspector. So there's a lot of activity at the beginning. And then once you've negotiated your repair amendment or the repairs with the seller, things kind of quiet down on your part. And then at that point, that's when your lender, the title company, everybody's doing things in the background. So that's going to be about a couple of 2 to 3 weeks of everybody doing stuff in the background. And then things are going to pick up for you again when closing gets close and, things like that are happening. You're getting your move set up and things are starting to get closer to closing. So this calendar is really, it's obviously generic because it's, every transaction is different, but it's kind of an overview of what to expect that 30 days before closing. This is going to be included in your slides too. This one is one of my favorite slides. It's the 10 commandments of buying a home. And these are things that you should or should not do, actually should not do during the period of time, that 30 to 45 days when you're looking to buy this home. The first thing you should do is thou shalt not change jobs, become self-employed, or quit your job. All of those things are going to affect your ability to obtain financing. Thou shalt not buy a car, truck, or van, or you may be living in it. Any changes to your credit are going to affect your debt to income ratio. They're going to affect your credit score. So everything needs to be as straight up the same as it did the day that your lender ran your credit. You should not excessively use your credit cards or let your accounts fall behind. If you're currently in a house and you've made an offer and it's accepted on the new house, that doesn't mean you can stop paying on the old house. You have to keep everything current so that it doesn't affect your credit negatively in any way. Thou shalt not spend the money you have set aside for closing, because if you don't have that money at closing, they don't let you close and you don't get to move into that house. So make sure when you're starting this process, you set that money aside so that you have the money when you get to the end and they tell you, okay, you need to bring $5,273 to closing. And you're like, oh my gosh, well, I bought all new furniture. I don't have that money anymore. They're not going to let you close. Thou shalt not buy furniture. That is also going to affect your credit. You should not have any inquiries into your credit. So don't go out and get a bunch of credit cards and buy a bunch of stuff and have everybody looking at your credit, because every time you have an inquiry into your credit, it does affect your score. You should not make large deposits without checking with your loan officer. What that means is any money that goes in and out of your accounts has to be verified. So if you have grandma has decided she wants to give you $10,000 for closing costs or $10,000 towards your down payment, we have to make sure that that is verified through whatever avenues required for that particular gift or that particular deposit. So always make sure if you're going to make a large deposit other than your normal paycheck, I mean, obviously your direct deposits don't have to be, because that's pretty easy to verify, but any large deposits need to be verified with your loan officer before you deposit it. You should not change bank accounts. That's also going to be a red flag to the underwriters that things are changing and you're not, you're not basically following the rules. And you should not co-sign on a loan for anyone. So during that time, they know what your debt to income ratio is. They know what you qualify for. And if you sign for your brother-in-law's friend's sister's new car, then that's going to add that amount of money into your debt to income ratio, because ultimately you are just as responsible for that money, for that debt as she is, or that person is. So don't co-sign on any loans for anyone. And if anybody has any questions about any of this, this is kind of high level, but please let us know and we can go through any questions that you may have. So now we're going to talk about home inspections, and Sarah's going to come back and she's going to tell us about home inspections.
Okay, so first of all, I'm not a licensed inspector. I'm a licensed agent, and I'm going to go over the slides for our inspector who has given us this information. But as an agent, I know about inspections, and I can give you real life application, or any of us agents can help you when you go through your inspection, when you find the house. But these are some high level things to think about with your home inspection, okay? During that option period, when you find your house, okay? How does TREC, which is Texas Real Estate Commission, what do they consider a home inspection? It's a limited survey and a basic evaluation of the systems and components of a building using normal controls, which refers to maybe weather outside, that provides information regarding the general condition of a residence at the time of inspection. So for example, when you're there, the air conditioning works, and maybe it doesn't work when you move in. So they're looking at it that day of inspection. They're giving their opinion as to how things work in the house, and they're noting everything in a report that you as the home buyer will receive in detail. So what's great about a home inspection? First of all, everyone should have a home inspection. It protects you as the new potential homeowner. Even on a new home, you should have it inspected by a third-party inspector who did not build the home, to get a second set of eyes. It gives you peace of mind to know that the foundation is okay, or the roof is okay. These are some examples. The property is inspected from a neutral point of view. I mentioned that, a third party, and you're going to get a formal document to help the agent, like myself, negotiate repairs on your behalf and ask the seller to cover these repairs if it's important. So what to expect the day of inspection? First of all, you probably don't want to be there as the buyer for 3 hours of poking and prodding through the home, going up in the attic. I don't like going in the attic. It's hot up there. So it's hot. I don't go in the attic. So what to expect on the inspection? Some of these things they look at as an inspector, they're looking at heating, ventilation, AC system, major appliances like a built-in stove, a built-in microwave, things that are going to stay with the home. The roof, of course, foundation I mentioned. They're going to measure the foundation to make sure there's no movement in the ground. Siding. These all seem kind of like not that great or important parts, but it's really important to know that what you're getting, as I call it, the house you're inheriting, is sound and in good condition. Electrical outlets, chimney, fireplace, the hardwood floors, drainage issues outside, safety considerations, like are there carbon monoxide detectors and smoke detectors, sprinkler systems, how are they working? And if you have a pool, I would strongly consider for an extra charge having that inspected also, because pools can be very expensive, okay? So you will make an appointment with the inspector. That inspector will go to your home that you're buying. You will meet with your inspector probably near the end of the report and get high-level information, okay? This talks about the quarantine. So right now it's a little bit different with the quarantine about how you're seeing your inspector. In the typical days, you would meet at the vacant house, typically not with the seller because this is your inspection rather, as the buyer. You have paid for the inspection, okay? Don't have any distractions like friends and family, like your aunts and uncles and grandmas are really excited, but you have to focus in on what the inspector is saying because it's important. You might miss something. And it's a learning process, especially if you're a new buyer. People who've bought 5 to 10 houses, it's kind of like old news and go, okay, what is it? How's the roof? Give me the bottom line. You know, or new buyers who are like, tell me every little thing. It's a learning process, and you can ask questions right then and there with the inspector present, or you can call them over the phone after the fact and say, tell me about this item on my inspection report. You have access to your inspector over the phone. That's what their job is. Some optional services that you can consider, I mentioned pool. There's also termite inspections. If the inspector sees evidence of potential termites, then you would have a termite inspection probably. A septic, if that applies to your home, if you're in more of a rural area, maybe Anna, you might have a septic system. That would be advisable. Another water well would be a rural area, more north. So let us know if you have any questions about the inspection process. We're here to help.
Thanks, Sarah. I appreciate that information about inspections. Now we're going to talk about homeowners insurance and what factors into a home insurance premium. Let's see. Factors that affect a homeowner's premium would be the age of the home. If you have a brand new home, it's going to be cheaper to insure than if a 50-year-old home, obviously, because there's going to be more issues. The value of your home, replacement cost, not the market value. So if you bought the house for $500,000 and you get there and the insurance says, well, we're only going to pay replacement costs, they're obviously not going to pay, you know, $500,000 because it doesn't cost $500,000 to rebuild your house. It also is affected by the location as far as the county and the zip code. Some counties and zip codes are more expensive and some are less expensive. You can have a multi-policy discount, like I have Geico, and my car, my house, my everything, motorcycle, everything is through Geico. So the more lines that you add, you can get a multi-policy discount. It's also going to be affected by your claims history. If you have a lot of claims in a previous home, or you have a lot of things that have happened in your past claims history, that's going to affect your premium. And then also your personal information, your credit. And we cannot stress enough how important it is, how important your credit is for any process in this whole home transaction. Your credit, your age, your marital status, your occupation, all of those things affect the premium on your homeowner's insurance. So the next thing we're going to talk about is a home warranty and why you need a home warranty. Most of us will negotiate the first year of your home warranty to be paid for by the seller. So that's going to help you when you move in. If there's anything that happens, you know, a month after you move in, all of your your hot water heater goes out, then that would be something that you could file with your home warranty. A home warranty is an annual contract agreement between a home warranty company and the homeowner. Coverage typically applies to major appliances along with plumbing, heating, AC, anything that breaks down from normal wear and tear due to frequent use. The purpose of a home warranty is to help to protect homeowners from unexpected costs of mechanical systems and appliances that are not covered under your homeowner's insurance. That would include your AC, big ticket items like that. They provide an easy, convenient way for you to obtain service from your home from a reliable repair contractor. And they also provide you peace of mind for your for one of your life's, you know, your biggest investment. You want to protect it. The things that are covered are your AC system, your plumbing system, all of your appliances in your kitchen, electrical systems, ceiling and exhaust fans, your garage door opener, any unknown conditions, or I won't say any, don't say all, but there are unknown pre-existing conditions that can be covered. You can have them come out for an AC tune-up once a year. Most home warranty companies will offer a rekey service where you can have your house rekeyed when you move in. And you can also have it cover your pool and your septic system, depending on the home warranty level that you choose. They provide great coverage for important features in your home, and it's definitely something that you want so that you can protect, you're not out of pocket. You don't have to move in and buy a new dishwasher because this one went on the fritz. So it kind of gives you some peace of mind there too, knowing that you have that in your back pocket. The benefits of home warranty, it is good for homeowners who have appliances that are getting old. Your house is over 5 years old. You do not have the time and the patience to get repairs done on your own. You do not have a trusted contractor and don't want to go through the process of calling and screening your own. You don't have a cash cushion to handle costly repairs. Imagine your air conditioner or heating unit breaks down and you need to replace the old unit. Those things can be so expensive, and it may cost anywhere from $6,000 to $14,000, even more to replace that, because depending on how old it is and what the situation is, how big your house is, and it would be the warranty provider's responsibility to replace that unit, not yours. You also want one if you're buying your very first home, so that you have the peace of mind, and you learn a lot from owning a home. But if you've never owned one, you don't know a lot of what's involved in owning one. So this will be something that can help you and also protect you from unexpected repairs. Now we're going to hear from Matt Davis. Now that you've bought your house, you've moved in, you've got your homeowner's insurance, your realtor is calling you and telling you what a great job you did. Thank you so much. We appreciate your time. Now you want to protect the investment that you are spending. This is going to be the biggest investment of your life. So now we want to hear from Matt. He's going to tell us what you need to do to protect your investment.
Thank you so much, Carrie. Guys, wonderful to be here today again. Once again, I just want to say thank you to Lacey and the Rushing Realty team. What a phenomenal thing to put on one of these Saturday mornings for everybody. Tremendous amount of information. A lot of these things end after the warranty piece, but Lacey and her team are very thorough. And so what I'm going to talk to you about today, I'm going to touch on 3 things very quickly. Once you've had this amazing team help you pick out your dream home, David's kind of helped you get your credit in order. James has come in, made sure you're pre-approved, not pre-qualified. The rest of the team's come out and inspected the home, put in your homeowner's insurance, and gotten a warranty on your home. One of the things you're going to notice when you get in that home is each day in your mailbox, there's going to be a letter from somebody saying you need mortgage insurance. And the first time I got those letters many years ago, I had no idea what they were talking about. And what they're talking about is life insurance, a life insurance policy on your life to protect the value of that investment that you just made. So there are many different types of insurance that one can look at, but in this particular case, what you're really looking for is something that is inexpensive that will protect the value of your home, and that's typically going to be a term life policy. I would recommend when you're out there searching for an insurance agent or an insurance company to check something online known as a Comdex rating. That's C-O-M-D-E-X. Comdex ratings tell you how strong the financial strength of the insurance company is. It is graded similarly to the grading scale that we all see in school, but let me give you a warning. In this particular case, an 80 is barely a passing grade. So on a Comdex rating, you want to see an insurance company, preferably with a 90 or higher. 80 to 90 is okay. 90 and above is really where you want to look. As far as determining how much insurance coverage you need, that's going to really rely a lot on how much you want to protect as far as the value of the home and any additional things you may want to replace for your family, such as your income. One thing I always like to touch on is that a lot of people focus on the life insurance piece because that is what you'll get blown up about in that mailbox. But a more likely scenario is that you become disabled in some way. And so I'd really stress that disability income is probably equally, if not more so important when protecting the value of one's home, because you need the ability to pay that mortgage. So DI is very important. One thing to touch on here, check your group insurance policies at your place of business, DI as well. A lot of times you can get a really good rate on a group policy. One thing to understand about that is if you're under the age of 40, the likelihood of you getting a better rate on a group policy is very high. 40 to 45, a little bit in between. If you're 45 or older and you're very healthy, there's a strong chance that you're going to be able to get a much better price on a personal policy than you will on a group policy because of the way they do the bands. The last thing I want to touch on is something that James brought up when he was speaking. And I do life insurance, I also do financial planning, and I spend a lot of time working with people headed into retirement. And he mentioned a Forbes article that spoke about the importance of building net worth by buying a home. And I've stressed this to many clients over the years. I have done many plans for people. And without fail, the clients who own their home as they head into retirement, almost always we're able to complete a successful plan for them to be retired in a way that they want to be. For those who have not been able to purchase their home by that time or are not very close to being able to purchase it, it's a lot more difficult. So he's spot on with the idea of not paying someone else's mortgage and putting that investment for yourself, for your future, into a home. Once again, thank you guys so much for allowing me to be a part of this. Lacey and her team, amazing job again today, and I will turn it back over to you, Carrie. Thank you.
Thanks, Matt. Thanks for the great information. So now we're going to kind of wrap it up. I'm going to let Lacey take us out of here, and we appreciate everybody being here today. I hope you got a lot of information out of this, and we are happy to answer any questions that you may have.